In this video, we're going to have a stripped down and raw look at my investment history, starting at the age of about 28, back in 2003, where I had very little invested, right up until last year. I'm going to show you the spreadsheet that I use to track everything in Google Sheets and my little milestones and things like that. Welcome to Destination Wealth. Before we get started, just like to say none of this is investment advice. It's just my own personal story and the investments I've picked. Some of them not been so good, some of them been great. But please do your own research. Seek out the advice of a financial advisor. If you want to invest in individual stocks, you need to do a lot of homework. You could just invest in ETFs and index trackers, funds, that sort of thing. As I'm getting older, it's the sort of thing I'm starting to think of transitioning more into rather than individual stocks to have a bit more diversification. So let's get into it and have a look at this spreadsheet. Here we've got my little investment tracker. It starts here going back to 2003 when I was just 28. Now I only had about it's when I first started not really investing. This was a stakeholder pension, I think it was, with my previous employer, and I had about £400 in it. That was about it back then. And I was paying in very little, £400 a year, £500 a year. Hardly anything. It was an afterthought, really. I wasn't really serious at doing this until, and I can't remember what got me into it. It was something, I think it was a documentary I stumbled across about stock trading or something like that, and I thought, oh, that's quite interesting. Read a few books and thought, oh, I'll give this a go. The first thing I did was open up a stocks and shares account. It wasn't an ISA at the time. It was just a standard investing account because I didn't do the research at the time to realise that I should have invested in a stocks and shares ISA for the tax advantages. But back in around 2008 was when I first opened that up. And so back then I had that year in 2008, I had about £626 in the ISA, and in the SIPP, which wasn't actually a SIPP then, I've called it that because I transferred it all into a SIPP. The pension that I had with a previous employer was just shy of £10,000. So overall, £10,468 at the age of 33 back in 2008. I started to increase my payments going in, £4,000 a year, £5,000. These are rounding up figures, so I couldn't remember exactly how much I was paying in, but it was no more than that. Quite small amounts. That was over a year period. And over here we can see, with excluding the contributions, how much I actually made. So when I was first started investing around here, I was really messing, didn't know what I was doing, buying, selling stuff, like trading, if you like. So I lost a fair bit of money here. This year was when I really started giving it a go, and I was looking at penny stocks, all sorts of stuff like that. So I lost £3,000 that year. I was £3,000 down, £1,900 down the year before. So yeah, these first few years of investing, the stuff in the pension was just in funds and things like that. So I wasn't playing about with that. I didn't really know what I was investing in. It was just going into standard funds. This money that was in the share trading account at the time, around this sort of time, I was just playing about, but didn't really know what I was doing. And especially that year, that first or second year, when I had only £1,800 there. The reason it was only £1,800 because I'd lost 3,000 of it messing around with penny stocks and things like that, and trading rather than investing. I didn't know what I was doing. As the years went on, over the next 3 or 4 years, I really started doing my homework and properly researching. I was still buying and selling. If I made a decent profit, I'd sell. And if I was losing a lot, I'd buy more, which may have not been a good idea. But I did all right for 3 years. 5,000, 7,000, nearly £8,000 profit over 3 years. And I still really didn't know what I was doing. The total investments were racking up. We went from 10,000 to 12,000 to 22. I was still only paying in £5,000 or £6,000 a year, but the increases were coming through. I was starting to get some dividends and things like that. And then, so if we look at 10 years ago, so around the age of 40 at 2015, in 2015, I had a total of £65,000 between when I started and what's that? 12 years later, I'd still only got to £65,000. That was a hell of a slog to get to, 12 years to get to £65,000. But things really started taking off. I did start paying in more. I got a much better job and I started paying in about £800 a month, roughly. Sometimes it was less, sometimes it was more, but it averaged out to about 10, 11, £12,000 a year. Some years I was paying around £1,000 a month. And I had a company pension. My ISA, which was, I transferred it into a proper stocks and shares ISA for that by that time. And I had my SIPP, my self-invested personal pension, which I transferred my previous pension into so I could invest myself and get rid of those funds that were really restrictive in I think it was a friend's provident or something like that. I now had control of everything. I was doing a lot better. There was a few down years, but the years after I was down, I either picked it back up again or increased it massively. So back in 2016, I lost £1,800, but the following year I made £20,000, and that was excluding the contributions that I put in. So I jumped from 108,000. That was a bit of a milestone there at the age of 42. Breached that £100,000 mark in fully invested. Now, that was across 3 accounts: pension, my ISA, my SIPP. But I'd hit that milestone, and then things really started rocketing from 108 to 126 to 157 to 167. There's some decent increases here. And what seemed to happen is whenever I had a down year or flat year, as long as I didn't sell out of everything and I held on and bought more, the year after, the gains were substantial. So that year there, 2020, we all know what happened around that sort of time, I was down £1,800. I didn't sell out stuff, maybe a few things, but I was mainly buying more. Look what happened the year after. I was up £66,000. So I just added more when the stock market was down the year before and made 48% growth. And that 48% is including my contributions of, what did I pay in that? I paid more in that year. So nearly £15,000 I paid in. I paid in £15,000 of my own money, but I actually made £66,000, £67,000 on top of that. That was a really good year. And then when I felt a reasonably flat year the year after, in 2022, 2023, however, was massively down £9,000. Again, didn't sell out, held on, and look how it came back the following year. I was putting more in now, £16,000 a year, 16,090 and 19,000 that year. On top of that 19,000, I made 11,000. So it was really increasing. You can see we jumped from 108,000 here, and then it's 1, 2, 3, 4 years later, I'd more than doubled that and half again, from 108 to 249. And then So between years 20 and 21 was when I hit £200,000 invested. It only then took me 4 years to add another £100,000 onto that, and then we're up to 305. We're now past that in 2025. But it just goes to show, even though I didn't know what I was doing really at the beginning, and I probably lost a lot of money, you can still do very well. Now, in hindsight, I think I would have held on a lot more to full market ETFs. I would have probably bought, it's always great looking back in hindsight, but I've probably bought something like the S&P 500 ETF, which also pays dividends, but spread across the whole 500 of the biggest US companies, and I would have done so much better. And I think ETFs are the sort of thing I'm going to be looking at going forward. I'm still going to keep the stocks that I've got, but I'm going to start transitioning more of my funds into ETFs to be a bit more diversified, lower fees. And I think that over the next 10, 15 years, it's just less work, less homework to do. You just buy the market. And as Warren Buffett said, unless you really know what you're doing, just buy indexes. You'll do much better than most, and everyone should be invested in the stock market. If you want to do the research, and you need to do lots of research into buying stocks, and I've done that and done okay. Some of them have been disastrous, but others have been really good. Things like Apple, I've got Apple diploma companies like that have done exceptionally well for me. But in hindsight, if I was being real, I think I'd probably just invest in ETFs. Now, stupidly, I did sell a couple because they weren't performing a couple of years ago, and I should have held on to them because they've come right back. So, hindsight's a wonderful thing, isn't it, when you're investing? Going forward, that's my plan. Let me know in the comments below if you invest in individual stocks, or do you invest in ETFs and funds? Do you just buy the whole market? Do you invest in the S&P 500? Do you invest in the FTSE 100? Let us know. It'd be interesting to see what the majority of people are doing when they're running their own investments. If you want to see exactly how I received £1,500 in passive dividend income in just 1 month back in January, and the stocks that I owned that did that, how much I owned of each of those stocks, how much each one paid me, and how much I expect each one of those to pay me as long as I hold on to them for this financial year, this calendar year, then just check out this video next.